I do not have. I can't see the chat. So, if you guys can just tell me if anyone asks any questions through the chat, that'd be perfect.
Yeah, I got you.
And just to confirm, I'll do compounding, mobile banking, Josh investing, Sostic, future planning, and I'll do fintech.
Just a warning, we are now live on YouTube.
Yep. What is the stream called? If I could just pull it up.
Do you see the live on YouTube?
Uh-huh.
So if you click on the down arrow, it should say view stream on YouTube, and that should bring you to the.
Oh, dope. Is the account called COVID Hacks?
Yep.
Perfect. Account called COVID Hacks. Oh, there's the delay. That's cool.
I can actually hear it from your computer, so you might want to mute the YouTube.
Yeah, yeah. Is that better? Josh, could you turn your camera on?
All right, Ed, would you like to get started?
Yeah, sure. Mindy, do you think we should wait for some more people, or do you think?
This is also going to be recorded in stream, so I think it's okay to get started. If you guys want to wait a couple of minutes, that's okay too.
Yeah, I think we'll start at 7.
Yeah.
We don't have any rush or anything, so if that's all right.
All right.
Perfect. All right, I think we can get started. Um. All right, so, thank you everyone for coming live or watching this. After it's been recorded. This is the FLEO workshop for financial literacy, and today we're going to be discussing financial literacy and fintech. Some important concepts about both. And just before we get started, we're gonna give you guys a brief introduction about who we are. So, what is FLEO? So, FLEO stands for Financial Literacy Education Organization. And we started when we learned that 66% of Americans are actually financially literate, which means they lack the basic skills that would protect them from cyclical poverty, homelessness, and other cities. And our goal is to provide you the tools to be financially stable. And we started after we realized that these core concepts are not being taught in schools. Only 17 out of 50 states actually have a mandate for financial literacy education to be taught. And even among those 17 states that teach it, they often leave out a lot of important concepts. So we're here to address that. And we hope you guys enjoyed the presentation. So the first topic we're going to be talking about is compounding and interest. Compounding is an integral part of business and finance, and these are both very important in order to be economically self-sufficient. So the first thing we want you guys to know about compounding is that compounding can work both for you or against you. So before we go ahead, let's understand what compounding is. So compounding by definition is a process in which an asset's earnings from either capital gains or interest are reinvested to generate additional earnings over time. Therefore, it is constructed with an interest rate in mind. And it's also important to understand the difference between simple interest and compound interest. Simple interest is simple interest only calculates your money from the original value, while compound interest calculates your money based on your most recent value. In simpler words, simple interest only generates a specific value based on your original amount and the fixed interest, whereas compounding interest adds an amount based on your most recently compounded value. So it puts an interest on top of your previously added interest. And an example of this is the famous math variable e that you guys might have learned in pre-calculus or calculus, and this is commonly seen in exponential graphs. Therefore, it allows you to grow your profits at a very fast rate. So why? I mean, we've learned all about this in school, but why is compounding interest from a business perspective in our daily lives? So, well, there are many applications of where compounding is used. Firstly, compound interest is a benefit for a depositor who wants to deposit money into the bank, and it's also commonly used in things like credit cards and student loans. And all of these are able to basically increase your profits over time. So, compound interest is constructed with time in mind as well. So, how do we calculate compound interest? So, we use this formula, and in this formula, we see that A is the final amount, P is the starting amount, R is the interest rate, and N is the number of times, N is the number of times the amount is compounded yearly. Um, and some generic rules of thumbs could be one would be annually, two would be semi-annually, four would be quarterly, and monthly would be 12. And T is the number of years you want to be compounded. And with this equation, you can calculate different aspects of your compounding plan by just solving for one variable, by maybe rewriting the equation, right? And although compounding may seem very beneficial for making profits, there are definitely many downsides that everyone should consider. And a quote by Albert Einstein actually sums this idea up perfectly. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So just like how profits can grow very fast, credit card debt, loans can grow rapidly as well. Credit card debt, if not paid immediately, could skyrocket, just like your profits can. So with one mistake, you could be swimming in a pool of debt. And one important way to avoid this is to make sure you pay off all your debt quickly so that you can avoid debt accumulation from compound interest. So that's what compound interest is conceptually. And just to solidify this concept, let's briefly look at some practice problems. We can just buzz through them real quick. So if $3,000 is placed in an account with an interest rate of 5% and is compounded quarterly, how much is in the account at the end of 5 years? So the first thing we need to do is we identify what our variables are by given the problem. Then we just plug them into our compound interest equation. And once we plug in the numbers, we can just use a calculator to find that the final amount is $3,846.11. Example practice problem 2. Suppose you have a loan that is compounded at an interest rate of 6.9% over 10 years. After the 10 years, you owe an amount of $100,000. How much did you originally put into the loan? So we do the same thing here. We first identify the variables given the information we've been provided. So we don't know what the value of P is, which is the principal. What we know, the final amount is $100,000. The interest rate is 6.9%. So in decimal form, that would be 0.069. N is 1 because it's only being compounded once a year. Oh yeah, sorry. One thing to mention is if the number of times it's not being compounded isn't mentioned, N would automatically equal 1. And the time frame we're looking at is 10 years. So plugging that into the equation will give us $51,312.47. And so the last example, we talked about how profits can really skyrocket, but this is a great example because this shows that you owe almost double the original amount. So when compounding interest can work for you, it can definitely work against you as well. So understanding compounding is an important part of being economically stable. If you can compound successfully, it will make you much easier to manage your money. So the next section we have for you guys is banking and money management.
All right, thanks for that, Tejas. And quickly, I just want to mention, if any of you guys have questions throughout the workshop, you can just put it in the chat and we will answer it as we go. Or if there's no time for it, we'll do it at the very end. All right, let's go to the next slide. All right, so what are the goals for this lesson? The goal of this part is to enable viewers and students to create a plan using the tools I provide in order to save up money and allocate it for future use. But ultimately, the main goal of this lesson is to teach viewers and students to become financially responsible and smart. All right. So what is money management? A lot of you might be asking yourself that question. But when you search up the definition of money management on Google, you get money management is the process of expense tracking, investing, budgeting, banking, and valuing taxes of one's money, which is also called investment management. Money management is a strategic technique to make money yield the highest interest output value for any amount spent. And so as high school students and young adults without much prior financial knowledge, this may be a bit hard to fully comprehend and understand or even make use of. So if we go to the next slide. The true definition of money management is the control of cash flow. It may also be referred to more narrowly as investment management and portfolio management. This will help you avoid a lot of financial problems like wrong investment or credit decisions. It'll help you reach your financial goals. More importantly, it helps you avoid incurring too much debt in the future, especially when you're heading to college as young adults. This is very important. Let's go to the next slide. And so, why am I stressing it so much right now? Well, scientists estimate that 42% of recent pandemic induced layoffs will result in a permanent job loss. And the overall unemployment rate shot to 14.7% in April, which is the worst since they've actually started recording back in 1948. With the second wave coming around, we can only expect these figures to worsen. This means that people will be losing their steady source of income that they heavily relied on, and be forced to make financially educated decisions or risk heading into poverty. Let's go to the next slide. The first tool I'm going to be giving you guys is balance sheets. They're a tool used much more often in the corporate scene, but can also be used to track family expenses. As young adults, you may not use them very often because they are very complicated, as I mentioned. And they're used to calculate equity, liabilities, and assets. And it also tracks overall net profit and net worth of a person. So these may be used much further down the road, but they're very important to know. On the other hand, you can use a budgeting plan today, or just in your daily lives as young adults. And it's a much more less cluttered and simpler tracker, as you can see. This can be used to track just simple purchases such as food, clothing, gas, etc. And it's a great tool that enables you to plan for future expenses and allocate your money to each category ahead of time. Next slide. So now we're talking about credit and debit in accounts. Credit and debit are two major terms that we often see thrown around just in general when talking about finance, but especially when using balance sheets. Credit is what you spend, for example, when you're buying groceries or just buying anything. Debit is on the left-hand side, while credit is on the right-hand side. Debiting is gaining wealth or having some sort of monetary income. An example could be selling a chair for $35. That'd be debiting $35. And on the bottom of the slide, you can see we have your account, and then you have debit on the left-hand side with a plus sign because you're making money from debiting, and credit is losing money on the right-hand side. So over there, you would have a total of $50. Let's go next slide. All right. Now we're talking about debit and credit cards. Anyone in the chat has any experience with them? Could you please just drop in the chat so we know whether or not you guys have any sort of experience or knowledge about this, because it's extremely different from debit and credit within accounts. I'll just give you guys a minute if you'd like to answer. All right, doesn't look like anybody has any sort of experience with this, especially since we are young adults. You aren't expected to have much. Well, debit and credit cards, as I mentioned, are very different from debit and credit when used in balance sheets. Debit cards use money directly from your bank account and use an interchange fee, just like credit cards. Interchange fees are transaction fees that allow the bank to make money off of your spending. Debit cards are cheaper as you don't have to pay any money back with an interest rate. You're only using money within your bank account, so you don't have to worry about paying money back at all. And credit cards, on the other hand, are similar to taking a loan from the bank and then paying it back with an interest rate. There's very great benefits to it, as you can have access to the bank's vast supply of wealth. But as I mentioned, you have to repay it with an interest rate. Credit cards also allow you to further build your credit score once you're 18. So as a young adult under 18, it may not be wise to use one. And if you build your credit score in the future, you may be able to take larger loans, whether it be a car, house, whatever it may be. Credit cards and a high credit card score become very useful. And a con of a credit card obviously is you may risk running into debt, especially as a young adult who can't build a credit score. It's not very useful since you don't want to pile up debt, especially before college, without much use coming out of it. All right, next slide.
All right, thanks, Mo. Our next topic is investment. So when it comes to financial literacy, investment is one of the most important topics, but it's also one of the most complicated ones. So how exactly does investment work? So first of all, investment is defined as the act of allocating resources, which is usually money, with the expectation of generating income or profit. And there's many forms of investing. So this goes from investing in the economy through the stock market or investing money in a particular company through loans. So what matters to us most today is investing in the economy, which is often through the purchase of bonds and stocks or through various funds. A bond is a certificate issued by the government or public traded company to repay borrowed money at a fixed rate of interest at a specific time. And a stock is a security that represents the ownership of a fraction of a corporation. So these are two very different concepts, so make sure not to mix them up. If it helps, you can think of them as such. A bond means that the organization that issued it to you owes you money that is to be collected at a later date. And a stock means that you own a part of the organization that issued it. So alternatively, there's mutual funds also, which are professionally managed investment funds that pool money to get together from many of the different investors to purchase securities. And these securities can vary depending on the type of fund. Mutual funds can invest in stocks, bonds, cash, or other commodities. Some funds cover multiple categories in order to be more balanced. And here's a diagram of the various types of mutual funds. And even this diagram doesn't cover everything, so I'm pretty sure you can tell how complicated investment can be. Some of the most important categories you might want to consider are index funds, target date funds, and exchange traded funds, or ETFs. Index funds are portfolios created to imitate a financial market index, such as the S&P 500. They contain stocks from all of the companies in the market index in order to mirror the performance of the economy as a whole. Target date funds are funds that rebalance asset class weights over time so that it begins to heavier stocks when you're younger and to heavier bonds as you age. So both index funds and target date funds are considered useful for retirement. Exchange traded funds are like mutual funds, a collection of securities such as stocks. However, they differ in that ETFs are listed on the stock exchanges and traded throughout the day, unlike mutual funds, which are only traded once a day after the markets close. And next slide. Yeah, so you also want to know how safe an investment is. So as a rule of thumb, here's a diagram of the different safety levels of various forms of investment. As you can see, individual stocks are usually the riskiest, but they have the highest potential for reward. Alternatively, forms of investment like savings accounts are the safest, but they comparatively have very little reward. So what you decide to invest in depends on your situation and your willingness to risk money. And that's a decision you have to make for yourself. Now, if you choose to invest in stocks, you'll need to be able to read the history of a stock. So pictured here is the Apple stock chart for the past 5 years. The letters in the top left are known as the stock ticker. In this case, it's AAPL for the company Apple. The white number at the top right is the current price of each stock, which pictured here is $318.19. And the red number next to it is how much that number has changed since the last market closure. So in this application, red means the stock has dropped, while a green number would have meant that the stock gained that amount. And the green line in the middle is the trend line. It marks the price of each stock over a period of time. As you can see in this trend line, Apple stock has generally had an upward trend in value. For Apple, this is a good thing. One thing you want to be careful of while looking at charts is knowing what time range you're looking at. A single day, a week, or even a month is not enough to tell you how much a company has been performing. So pictured here is the last 5 years, which gives a much better understanding of Apple's history. So in addition, you shouldn't be worried about sudden drops or gains in the company's stock price, because many factors can affect the stock, such as changes in leadership, release of new products, political events, and more. So one example of this is the current COVID-19 pandemic, which has greatly dictated the course of the market for the past few months. And if you can see in this chart, the blue arrows pointing to a dip in the chart, where this is kind of where the COVID-19 pandemic started, and it went back up as time went on. And based on this chart, you can try to see what possible future changes would occur in the Apple stock. Next slide. And then here's a chart of the Tesla stock over the past 5 years. So you can go ahead and give it a quick glance. Try to see if you can understand the changes and the general trend. And you try to think of any reasons why the stock price acted this way.
And while you guys are thinking about that real quick, I saw a question in the YouTube chat. I'm just gonna read it out real quick. It says, why is n equals 4 in quarterly compounded interest if 4 divided by 12 equals 1/3? That's a great question. The way you think about it, it's actually, there are 4 quarters in the year. So that's where n comes from, right? Because if there are 4 quarters, with each quarter, you're going to be compounding the value. Therefore, given that a quarter means 1/4 of something, there's 4 of them. If that doesn't answer your question, let me know, and I can maybe rephrase it or offer something more.
Okay, so now that you guys have had time to look at it, so I'll try to explain some of the trends in this chart. So as you can see in late 2019 and early 2020, there's a large rise in the Tesla stock. That was mainly due to the amount of products that Tesla released at that time, like the Cybertruck, their new ATVs, and their semi-trucks. So that had a great increase in their stock because investors wanted to invest now that they knew what they had in store for the company. And then the dip after that, just like the Apple stock, is the COVID-19 pandemic, where it quickly went down and rose back up. Next slide. Yeah. So now that we've gone over the basic concepts of investment, we should go over why does it matter to you and why should you feel the need to invest at all. So first of all, there's numerous ways to invest. There's almost certainly a method out there that suits your personal style. So people often have the misconception that investment is only for rich elites and and people with vast amounts of money to spend, which is totally untrue. It's flexible enough that anyone who wants to get involved can get involved no matter how much money you have. And investment doesn't have to be a risky business if you don't want it to be. And another upside is that it's a good way to get involved with the economy. The economy relies heavily on investment and transactions in order to stay strong. So by getting involved, you can contribute to the overall stability of the economy. And you can also get personally involved with the industries that matter to you. So your investments can help change the future. In addition, investing early can provide with long-term benefits, and planning for the future can greatly be impacted by your investment decisions early on.
Thank you, Josh. We'll be moving on to future planning now. So, yeah, next slide, please. Okay. Let's talk about college, which for many of us is in the near future. According to a 2018 report by the Federal Reserve Bank of New York, as many as 44.7 million Americans have student loan debt. In other words, 1 in every 6 people over the age of 18 have student loan debt, owing over $1.5 trillion. Let's go more in depth on what student loans are. They are loans taken by students who are unable to fully pay for college. And like we've already mentioned, students will have to pay it back with an interest, which means that they will end up paying the bank more money than the student took from them. And interest rates going from 6% to over 30 or 40% in some cases, it's important to not take out more money than is absolutely necessary. However, there are some ways to reduce this cost, and one of these is through scholarships, which are financial aid awards designed to help help students reduce the cost of how much to pay for an undergraduate degree. Over $46 billion in scholarships are given out each year. Not only that, but there are multiple ways to receive them. And there are 7 common scholarships granted by organizations and colleges, such as for community service, athletic achievement, hobbies and traits, personal background, financial need, and family workplace or military affiliation. These scholarships aren't just awarded by colleges, and some programs and organizations also grant scholarships to students in a number of ways, like winning a competition or through your own personal achievements. One example of a company that is well known for doing this is Coca-Cola, which has given out over $66 million to help students. It's also important to remain frugal, which means to be selective in your spending while in college. This can be achieved by cutting spending from simple tasks such as commuting from place to place, or more advanced tasks like creating your housing and meal plan for the entire school year. You don't have to spend extra. By cutting back on this spending, you can dramatically change the amount of money that you owe through student loans more. Since we've been talking so much about life during college, let's talk about life after college. So next slide, please, Sage. Okay. So although retirement is a long way away, it never hurts to start learning about it right now. The most common type of retirement plan is a 401k, which is a plan that is normally offered to you by the company you work for, and its goal is to set aside money for retirement. This money comes from your paycheck and goes straight into a 401k account. You may ask, why is a 401k account so important? Well, it's important because it helps you save money for retirement and also provides you with benefits along the way. For example, some companies may offer an incentive, such as for every dollar you put into your 401k, the company will match it with 25 cents. And another benefit is tax reduction. If you put money into your 401k, and the IRA will grant you a tax deduction on your adjusted gross income at the end of the year. So an example of this is, say you make $100,000 a year and you put $20,000 of that into your 401k. At the end of the year, you will only be taxed as if you had earned $80,000 that year because your tax is deducted by the $20,000. Another bonus about a 401k is that you can use this money to invest into the stock market or in bonds. By investing in stocks and bonds, you can get up to an 8% return annually, depending on what you invest in. Another common retirement plan is the IRA, which is an individual retirement account that allows an individual to save money for retirement with added bonuses such as tax-free growth. And just like the money in 401k accounts, the money in IRA accounts can be used to invest in the market. There are three types of these. The first one of these is the traditional IRA, and the benefits of this are that you can invest pre-tax dollars or post-tax dollars. However, a limitation of this plan is that you must begin to withdraw your money once you reach your 70s. The second way is the Roth IRA. In this plan, you will be investing after-tax money, or in simple terms, money that has already been taxed. One reason why this is popular is because after the age of 59, withdrawals are tax-free. Not only that, but because the money is invested in after-tax money, it will no longer be taxed, meaning that you can gain substantial amounts of money by investing it into the market. While this might seem like a very good plan, there are also some limits of this, such as you might start losing the ability to contribute to a Roth IRA if you are single and if you earn over $125,000. The last plan is a rollover IRA. In this account, you will invest money that has been rolled over from a qualified retirement account. This means that you can move some or all of your money from a retirement plan into this account. Normally, rollovers occur from a 401k account to an IRA account. As you can see, both 401k and IRA are both long-term savings plans which lead to you having a constant source of income. Remember, investing is not about investing into the market, but into your future. Okay, next slide, please, Taves.
All right. Thank you, Swastik. So today, we've gone over a brief rundown of some financial literacy concepts, and now we're going to talk about how financial literacy and business overall relates to tech. So the first thing we're going to do is we're going to kind of understand what fintech is. So fintech is essentially, as the name suggests, finance plus technology. So fintech, a simple definition of fintech is the automation of financial services. And for someone who's never heard that before, that can come across as something kind of confusing. So let's break it down. So the first thing we see here is the word automation, right? So automation is essentially using technologies or using a method to make the whole process seamless. And the process we're talking about today is financial services. And a financial service is anything where money is exchanged. So using technology, we're automating financial services. So some examples of financial services could include, say Joshua's been a great friend to me, and he's bought me some McDonald's for $5, and I want to pay him back, right? I would have to go to Joshua's house. Say it was 30 years ago, I'd have to go to Joshua's house and give him $5 in cash. But today, if he's paid for me, all I can do is I can take my phone and I can Apple Pay him or Venmo him for $5 because he's bought me that McDonald's, right? So basically, any process that used to be done in person, for the most part, can be automated through technology. So there's a lot of great examples. So first we have online banking. We'd see examples of this through applications like the Wells Fargo's mobile app, Bank of America's mobile app. Um, Second is payment services, just like I just alluded to. There's Apple Pay, Venmo, PayPal, all applications we can use our phone to send money through, or basically using the internet. Third is cryptocurrency. An example of that is Bitcoin. For those who don't know, cryptocurrency is a decentralized, digitized currency, and what that means basically is it only exists on the internet. For example, the U.S. dollar, we have it on the internet in the sense we can do transactions of dollars with our computers or with their phones, but we can also exchange it in paper money. But that's not the same for something like Bitcoin because it's completely on the internet. And an interesting fact about cryptocurrencies: a lot of people find cryptocurrency actually safer than something like the U.S. dollar or other currencies because it's decentralized, because it's not manipulated by one government or by one corporate entity. So that's just a little bit about cryptocurrency, and that's also an example of a fintech, and moreover, an emerging fintech. Fourth is a crowdfunding platform. So I'm sure anyone who's participated in a nonprofit activity is familiar with something like GoFundMe or other platforms where you can raise money to support certain causes or certain events. So yeah, these are examples of fintech that we see on a daily basis. So the reason fintech is really important is because one, it is a part of our daily lives, whether we know it or not. We're using fintech through buying stuff on Amazon, through ordering a cab through Uber, through buying something on the App Store. We're using fintech, and it's all around us. Second, it's one of the fastest growing industries, and that rapid growth is allowing for a lot of opportunity. So if you're an entrepreneur or you're someone who's very ambitious and is looking for an industry or a niche to fulfill, fintech is a great place to look, just because there's so many new opportunities as new fintech technologies are being created every day. So, given that we're at a hackathon, let's talk about an intersection of finance and technology. And something that really embodies that crossroads is algorithmic trading. So, what is algo trading? And algo trading is just algorithmic trading for short. So, can you guys see my mouse? Can you just nod if you can see my mouse? Okay. So algo trading is essentially the use of code to execute investment strategies. So what that means is, if you're building a website, for example, you write code to execute your website and the operations that your websites consist of. But here, instead of executing a website or executing a program that like a calculator program or whatever program you build, you're using it to carry out your investment strategy. And to better understand algo trading, we need to understand what an MA or moving average is. And moving average is a smooth indicator of stock trend based on past data points. Um, so we can look at an example for moving average right here. So right here, this is GE stock on the New York Stock Exchange, and we can see, like Joshua mentioned, stocks are extremely reactionary and they fluctuate a lot. So here we see GE stock fluctuating a lot. So writing a program using these data points will be a challenge, right? Because it's harder to build a threshold or build certain conditions because the numbers are just hard to work with. But underneath it, we see this moving average line, which is a smooth line. And what it actually does is it still encapsulates the trend of the stock. It's still reflecting the same slope of the stock, but at the same time, it's much easier to work with because the numbers are more consistent. And naturally, if the amount of days in consideration are smaller, then the moving average is more sensitive. So if we're talking about a 20-day period, the events of the day have a greater impact on the stock and then therefore the moving average. But if we're talking about a 200-day period, naturally, each day's events are weighted less in the grand scheme of things. So an example for you to better understand algo trading is you could think of something like, if the 20-day moving average moves up by X amount of points, then buy 50 shares. So we'd write code that would have a conditional statement. The input would be if the 20-day moving average, and if it passes a condition, which is X points. So if it surpasses X points, then the if statement would be triggered. The conditional would return true, and then the body of code would be written in such a way that you'd buy 50 shares. So some benefits of algo trading as opposed to manual or discretionary trading. And manual or discretionary trading is what Joshua was talking about earlier, which is you personally go buy stocks. So firstly, it eliminates emotion or bias because we're relying on a program. Our human biases don't have any chance to impact our decisions, right? Because the code has no emotion and has no bias towards certain things. And as humans, we have a lot of psychological biases and preconceived notions about certain things, and that often hinders our pure and analytical decision making, which is often very effective in trading stocks. Secondly, it allows for constant monitoring, which basically means an algorithm can always look at the stock market, but you can't always, right? Unless you're a day trader that spends a lot of time looking at the stock market, it's just not possible for you to spend your whole day looking at the market. So this not only saves time, but it ensures the consistency of your strategy. Thirdly, it enables the backtesting of strategies. And backtesting is basically checking the efficacy or effectiveness of a strategy through the use of historical data. So you're using past data points, um, uh, like your test code, for example. So like typically for test code, we have to write a block of code to see if our program's working. We're just using these past data points because it's already happened, of course, since it's in the past, and we're using that to test our program to see if it's working because we know what the correct output should be, given that we're in the future. And overall, the reduction of human error due to reliance on code, it's not a factor of man versus machine or anything of the sort. It's a fact about how man can best use machine, and in this case, make maximum profit. So we're going to talk about two main types of algorithms. There are many different types of algorithms, but these are the two main ones you'll see in algo trading today. So the first one is a profit-seeking algorithm, and as the name suggests, the main goal is to make money, right? You're doing whatever you can to make the maximum amount of money possible in the shortest amount of time. And examples of these are strategy-driven and predatory algorithms. And I'll get to predatory algorithms in a sec, but strategy-driven algorithms are basically constructing an investment strategy and carrying it out and writing code to carry it out. On the other hand, order filling algorithms essentially allow you to buy small portions of a larger investment. So that means if I want to buy 10 shares of Apple and I have the money to do so, I could just go ahead and do it, right? But if I have a lot of money and I want to buy, for example, a million shares of Apple, right? An investment that would move the market, um, I would buy small portions of this large investment. So for the next how many ever days, instead of buying a million shares of Apple in one day, for the next how many ever days, I'd buy 200 shares of Apple per day till my order is filled. And one more note about moving the market. Moving the market basically means, in this case, driving the stock price up. And as a rule of thumb, you should know that the more people, or rather the more money that's invested in a certain stock, the more the price will go up. So if I make a big purchase on one day, the market will be impacted. That's usually not the case for individual traders, just because unless you're like Warren Buffett or Jeff Bezos that has the financial capacity to do that, it's hard. But if you are perhaps working in a private equity firm or hedge fund that controls large sums of money for your client portfolio, you have the capability to do that. To do that, I can't say those words today apparently. And it's often the hedge funds and private equity firms that are actually the ones employing the order filling algorithms. And examples of order filling algorithms are VWAP, TWAP, and time slice algorithms. And they're basically three different implementations of how you can fill an order in the long run. So a note about predatory algorithms. So predatory algorithms are essentially algorithms that look for large order filling algorithms, and once they find that okay, there's like this big investment going on, like every day, like this there's like somebody investing into this stock X amount of times a day, that means there must be like a big investment on deck. They can actually, a predatory algorithm would actually, if it works well, it would detect that someone's making this large investment, and to capitalize off that, they would actually invest themselves. So it's kind of like a predator who's looking for prey, and in this case, the prey is often order filling algorithms. So what are some steps to get involved in algo trading? The first thing you want to do is you formulate your strategy, and this is for anything you do in programming. The first thing you do before you actually start writing code is, in your mind, you get a good idea of what am I trying to do. Once you figure that out, you can convert your strategy into code. And then you backtest, like I mentioned. You use past data points to see if your code is working. Then you implement risk management, like adding limits, stop losses, exposure limits, and they're basically to protect you from protect your program from losing a lot of money. So if the market goes crazy one day and your algorithm hasn't factored like a market crash, you could lose a lot of money, especially when you're not manually trading. So your algorithm should have these limits that kind of protect you from catastrophes, for lack of a better word. Step 5 is you want to simulate with real life data. This is also known as paper trading. It's investing in the stock market without actual money. So it's kind of like a simulation. And it's a lot of fun for people who don't have the capacity to invest straight away, or if you're new to algo trading, it's highly recommended that you do this first. The sixth step is to start trading, but you have to ensure to start slow and then you scale up. So as you build your confidence, as you build faith in your algorithm, you can slowly start investing more and more money, and hopefully make profit. And throughout this entire process, you want to test your code and optimize your code. So I'm sure every computer science teacher or person you know has told you that you want to test your code, and test your code until you are 100% sure it won't crash. There's no bugs. And you also want to optimize in this case. And for those who don't know, optimizing your code is essentially making your code run faster. So examples of ways you can do this is you can use less lines of code. You can use less variable names. It's essentially using less memory, so your operating system goes faster and you can make trades faster in this case. So here's some resources for algo trading. The recommended language is Python, but alternatives do include C++, C Sharp, and Java. Resources are Quantopian, QuantConnect, and QuantRocket, and these are just platforms that help people that people use. And the reason they use them is because one, they allow for backtesting, so they offer you those historical data points in the platform itself, and that saves a lot of time. Secondly, like I mentioned, they're all Python based, so even if you don't know Python, but you know one of the alternatives like C++, C Sharp, Java, it's very easy to learn. It's just minor syntax differences. And lastly, the platforms include live trading simulation. So like I mentioned, you can actually test your algorithm against a live stock market without actually investing any of your real money. So it's a great way to get experience and not lose any money. But I believe this is a great time for questions. This could be on any of, oh, I'm disappearing. Let me turn on the light or something. All right. Oh, okay. Yeah, I'm back. Sorry, guys. Oh, yeah, but this is a great time for questions. If you have any questions on anything we covered throughout the presentation, whether it be fintech or anything else, we'd be more than happy to answer. So, yeah, you can put it in the YouTube chat or the Zoom chat, and then we can answer questions. Gonna wait on here for a bit. Oh, I believe there's a question in the chat, on the YouTube chat, that is. Question from Thomas. He asked, how can good coders trade? So that's a great question. So for something like fintech, it's more than just being able to trade, and it's more than just being able to invest. You need to really perfect both those skills. So that's why we recommend, if you're a good coder, you brush up on your investing skills so you have like a really cogent investment strategy. But if you're a good investor, you need to brush up on your coding skills to create the best algorithm you can. Have you guys made any apps using algo trading? So you don't really make apps during algo trading, but you rather make programs that carry out in the market. But yes, certain members on our team have been very successful in algo trading. I'm still working on my first one now. And one thing off the bat, I can say that it's a lot more fun than regular trading, just because I use Quantopian, like I mentioned on the resources slide, and it's just much more fun because you can actually see your program making a difference. And yeah, I think that's really cool. And any more questions? We have a lot of time, so we'd be more than happy to answer anything else. Anything else before we wrap up?
Yes, I believe there's another question in the YouTube chat.
Oh, okay. Oh yeah, from Thomas again. He said, "How can one join FLEO?" I'm glad that you asked that actually. So so FLEO, before we just go back to resources, yeah. So, like we mentioned, FLEO is a student-led nonprofit organization, and we're always looking for more students to join. So far, we have a team of 40 students globally. We have 5 different teams. We have a North America team, a Europe team, an Asia Pacific team, an Oceania team, and an Africa team. So, Thomas, depending on your region, you just apply to the main team, and then you can work with the team based on your region. So, if you put your email in the chat, we can actually um, help you. We can actually reach out to you. So, if you just put in the chat, we'll save it. But yeah, other than that, on resources, we highly recommend everybody continue your financial literacy journey. Look into algo trading. I think this is a great opportunity for people of our age group. Yeah, my bad. I'm teaching a workshop, but I don't think my dad knows that. Anyway, so yeah, depending on your region, you can join. And yeah, that's pretty much it. If you have any other questions or or you want more resources, like I said, you can drop your email in the chat and we can reach out. But till then, thank you guys for your time. We really appreciate you coming. There's a question. What do you guys do on the FLEO team? So yeah, so we create workshops like this, and we present workshops. We create workshops. We have our own newsletter. We're planning a very big event this November, and our main goal is just really to expand financial literacy to as many people as we can. So far, we've reached 4,500 people, and we hope to keep going. So thank you everyone again for coming. Thank you to Mindy and COVID Hacks for having us. It was a joy for us. So thank you.
Yeah, I just put the link to our website in the YouTube chat. If you'd like to check it out and even more questions, it should be answered there. If not, you can reach out to us or on LinkedIn. And I think our email might be on the website. You can just contact us for more questions or if you'd like to join FLEO, just don't hesitate. Go ahead.